Welcome to the Strategy Spark. Okay, so Revolut just got a banking license in Australia, and it's not a partnership, not just any workaround. It's an actual, unrestricted, we are now legally a bank kind of license. And if you know anything about how Revolut talks about itself or how fintech in general talks about itself, that should kind of sound completely insane to you. Because for the last 10 years this entire pitch, the whole vibe was like, oh, we are not a bank. In fact, we are better than a bank. And now the poster child for that idea is literally becoming one. So today I want to talk about why that is happening, and not just at Revolut, at basically every major fintech at once. And I want to argue something that might sound a little controversial if you are in the industry. Although I don't think this is hypocrisy, I think it's actually the smartest move these companies could make. So let's get into it. Before I start, welcome to the Strategy Spark podcast. I'm your host, Sanghamitra, and I'm talking about this topic today. Thank you for liking, subscribing, and sharing the videos. It helps the algorithm, so keep doing what you're doing. Okay, let's get back to the topic. There's a kind of a quote um, by Bill Gates that started this entire thing. So we have to rewind back to 1994. Bill Gates says this line. It's an interesting line. He says, well, backing is necessary, but banks are not. So he's talking about, ATMs. This is the way before apps, way before fintech as a category even existed. But that line just sits there for 20 years, I would say. And then around 2014, it becomes basically a scripture for a whole generation of founders. Because the logic is genuinely good, banking, which is the actual function, moving around money, holding money, lending money, that is not going anywhere. It is going to stay for a significant amount of time, if I may say. But the bank, the institution, the branch, the queue, and the guy behind the glass, well, that's replaceable. We are already seeing the evidence of that, right? So, you get this wave of companies built on exactly that idea. So, Revolut, Monzo, N26, Nubank, Chime, Strolling, all these. And by the way, it all works. Like, it really works. These aren't struggling startups. We are talking tens of millions of users, IPOs, some of the, you know, most valuable fintechs companies on the planet, by the way. And that is important, right? Because this isn't a story about failure. This is a story about what happens when disruption actually succeeds. So here's the twist. And this is the part that, made me want to record this episode. Uh, in 2025, the OCC in the US, that's the main US, bank regulator, they get around 14 applications for new bank charters. That's almost as many as the previous 4 years combined. And by the year 2026, Bloomberg's tracking at least 17 fintechs with a live banking license application in the US alone. And it's not the struggling ones, dear. It's Revolut. It's a big, giant fintech. It's Nubank, which just got conditional approval to literally become a new bank NA in the States, of course. Similarly, Affirm, PayPal, Mercury, Stripe. Stripe who will tell you with a straight face that, well, we are not even a fintech. But all filing for some reason for a bank charter right now at the same time. So the same companies that spent a decade telling you that bank branch was dead and are now standing in line at the regulator's office asking to open one. So I actually think most people's instinct here is to go, hypocrites called it. And look, that's a fun take. It's got some bite to it, but I don't think it's actually right. I think it misses something way more interesting. So, a quick detour, if I may, and I promise this will pay off. So, I studied disruption theory through a Harvard Business School course a while back, And there's a very specific model here from Clayton Christensen that I think explains exactly what is happening. And almost nobody who casually uses the word disruption has actually read the part that really matters. Because the popular version of disruption theory is small, scrappy company beats the big, slow company. But that's not really what he said. The action model is a disruptor enters at the low end, somewhere the incumbent doesn't think it's worth defending, and something worse by the old scorecard, of course, but cheaper, more convenient, good enough, and it wins that low end. And then there is a part that everyone skips. It moves up market. It keeps improving until it can serve the customers the incumbent used to think were completely untouchable. And that is exact the point. It stops then being a disruptor and it becomes the new incumbent. So, coming back to our own topic, this is exactly the shape of the story. Fintechs came in at the edge, prepaid cards, peer to peer transfers, a savings account with a nicer app sitting on someone else's banking license because they didn't need their own yet to serve that slice of the market. And that was a disruptive move, sure. But getting a charter, your own balance sheet, your own lending book, your own regulator, that's the upmarket move. That's the next move, to be honest. It's not a betrayal of the theory. It's literally act two of the same theory. So the next thing which crosses my mind is, and okay, all these are nice and amazing, but why now? Why this specific moment? So two reasons. One very boring and one very dramatic. Okay, so the boring one first, let's get it out of the way. If you are a fintech, riding on a partner's bank's charter, you are basically a tenant. So you can't really set up your own lending terms because the loan is, legally sitting on someone else's balance sheet, so to say. And of course, you can't grow your deposit product past whatever your partner bank's risk team is comfortable with. And at a certain scale, that arrangement just doesn't work anymore. You have outgrown the apartment, now you need to buy the building, so to say. And now, the dramatic one. Yes, 2024. A company called Synapse, if you've heard about it, most people outside fintech might not have heard about it. But that company collapses in 2024. Synapse was kind of a middleware. It sat between a bunch of fintechs and their partner banks, reconciling who owned what to whom. Now, when it went under, like over 100,000 customers got locked out of their accounts, up to $265 million in deposits that people generally believed were federally insured. And regulators didn't just go after Synapse, they went after the partner banks directly. So that one event did more to change this industry's thinking than any manifesto or pitch deck ever did. Because it proved that, we don't own the rails kind of isn't just a limitation of growth, it's a genuine risk to your customers and to you and that we don't fully control, right? So you've got growth pushing companies, towards owning a charter, and now you've got fear doing the same things. So that's pretty much a strong combination. So next part is a little bit interesting part of the case studies. If you take a quick tour, because the specifics are obviously and honestly the fun part. Let's take a Revolut back in the uh, canvas. Revolut did this very deliberately, market by market. So UK license, then the European license, the EPA, then Mexico, and now Australia. US is still pending, but I think this is overall a textbook execution. Monzo and Sterling. Now both these, well, now it's a bank, but before it was neobanks. They both got UK licenses within a couple of years of launching. Back in, I think it's in 2016 or 17. Monzo actually tried this in the US too, Of course, US is for growth, right? Spent almost 2 years on it, pulled the application back in 2021, but then got a European license at the end of 2025 and shut down the US business 3 months later. Now, which I don't think that's not just a coincidence. That's a company telling you exactly where it thinks the future is. I mean, sure, maybe the US is not the future for them. When it comes to N26, it's the same story, almost a little bit, earlier, I think. Strong in Europe since 2016. They also tried the US and walked away in 2022 once the math didn't work out. And then we come to Nubank. It builds its own infrastructure very early, scaled to tens of millions across the Latin America, and now it's going for the US charter too. And then there is another neobank, or should I just call it as a bank now? It's called Bunk. It's a Dutch based digital bank. This one is actually the outlier. It's very different from all the other examples I've just mentioned. And I love this example, because it breaks the pattern in a very useful way. So Bunk actually got its Dutch banking license almost immediately after founding, before it even had a public app, to be honest. It never really went through the disruptor without a license phase, just like the others did, uh, which kind of raises a generally interesting question. Like, was the whole, rent a bank era ever actually necessary? Or was it just the only version of this business that venture capital, was willing to fund at the time, right? So, well, I don't have a clear answer to that one. I just think it's worth sitting with. Okay, so here's the part I think doesn't get said enough, and it's the actual controversial bit of this whole episode. Uh, Getting a charter is not free. Just so you know, it comes with capital requirements, examiners, deposit, insurance rules, and those exists actually for good reasons. But they are, by design, very slow and more conservative than what a venture funded, a product team is used to. So some of the fastest growing fintechs on the planet are about to get noticeably slower over the next few years. I think that's my personal opinion. And this is not because they're losing their edge or something. No, it's not like that. Because the thing they're actually gaining is permanence, which is a slow process, of course, which is the ability to actually own the lending and the deposits at scale, and cost exactly that. And I think that's the real trade-off here. Way more interesting than did the fintech sell out. I think it's what do you give up to become a permanent, and are these companies actually ready for that culturally, not just legally, to be honest. So here's where I land now. So this isn't, a fintech losing a plot kind of episode or a conversation. Bill Gates' line holds up better than people give it credit for. Banking stayed very necessary until now, and I think it will be necessary for a long time from now. But the old banks weren't. And it turns out the fastest way to actually own that function at scale is to become the new institution built to hold it. And and the plot isn't, twisting or anything. It's actually arriving exactly where it always was going. Okay, saying that, I've got this entire episode in more detailed and a written way and a full breakdown on my Substack with all the sourcing, the companies, comparison, the disruptive theory, everything which I couldn't fit into these 12, 30 minutes of this podcast. And the links is in the description if you want to go and check it out. And and generally, I want to know what you think, because is a banking license the finish line for a fintech, or is it just a starting line? So drop it in the comments, or maybe you can visit my Substack or LinkedIn to drop comments there, or get in touch with me if you want to really discuss this in details. Thanks for listening, and see you next time.